Hi, I'm Kim Curtis and CEO of Wealth Legacy Institute. And if you're a business owner, I'm here to help you avoid some common pitfalls. And as a certified financial planner, CFP, I work with a lot of business owners and also myself being a business owner. So I have three big mistakes. And even though every business is unique, a lot of the issues tend to be somewhat the same. So, in this Wealthcast, I want to talk about some of the most common business mistakes that I have seen lately. And, as business owners, we have so much on our plate. I just think of myself with operations, accounting, finance, marketing, staffing, technology, continuing education. I'm already exhausted. So, for you and your business, we are here to add value to our people we serve. And so the backside of the operational piece and everything we need to do in addition to the services, a valuable service that we provide can be daunting. And so let's just focus on three that I tend to see over and over that, again, that could cost you big. Number one, the first mistake is not knowing what kind of business structure or entity is right for your business. So, it's very important because it depends on whether you set up an LLC, an S Corp, or a C Corp, and so on. The structure affects your business taxation and liabilities, and even further, when you decide to exit your business, the structure of your business makes a significant difference. So, understanding the differences of entities and which one is right for you is a crucial first step to any business owner. And what happens is oftentimes we hang our shingle, we set up shop, and we don't create any structure, and we end up being self employed. And when we're self employed, that actually doesn't help us as it relates to maximizing taxation advantages. And number two is not planning for your exit. Uh, we start businesses so eventually we can sell them. That's the whole point of being a business owner. So, what do you plan to do with your business? Will your children or grandchildren take it over, or some employee? Where if you're going to sell, how will you structure the sale? To maximize your success and, of course, reduce tax liability, like I mentioned before? Or is selling your business your retirement plan? All three of those require very different structures in terms of entity exit plan. And so you want to make sure, why are you doing this? What is your strategy to exit? And does everything fit in alignment with what your future needs to do? Because some people start a business and when they get close to exit, actually change the business structure to make it more attractive. And then finally, number three, not paying yourself the right way. I know you would think that would be the first thing that we would want to focus on, right? Many entrepreneurs that I see take their income in a way that does not maximize their goals, and it also limits their tax liability. So, having the right payment structure in place can help you accomplish all of that while avoiding raising red flags with the IRS that can lead to a very painful tax audit. So, if any of these mistakes sound familiar, follow up with your tax professional or discuss with your financial advisor to make sure that you're on the right path for a very successful business. So, I hope this is helpful. If you found it helpful, please share, like, and pass along, and have a super, super day.